Well, what I think is that if we want to talk, and I talked about this with you before, like the game of money. And if we think about how to build wealth and what wealth tools do we have available to us, we understand that Bitcoin is the cheat code for us to do that. And Bitcoin allows us to use all these tools that the 1% typically had. So Bitcoin allows us, but we have to build a system for building wealth around Bitcoin. Mm-hmm. And so Bitcoin treasuries can be one piece of that system that we can build.
One of the biggest misunderstandings in the Bitcoin space today isn't about Bitcoin itself. It's about how Bitcoin fits into the real financial system that actually exists, not the one we wish existed. Mark Moss makes a critical distinction in this conversation. Bitcoin maximalism is philosophically correct, but practically incomplete. The sound money thesis is right. Fiat is broken. Inflation is theft. Jeff Booth's "don't feed the system" ideology is logically sound. Mark Moss starts with a simple but uncomfortable truth. Almost nobody owns meaningful Bitcoin exposure. Less than 1% of people globally even have a 5% allocation to Bitcoin. And even those hardcore holders still keep 95% of their capital in other assets. Before we go on, just a quick reminder, liking the video, subscribing to the channel, and commenting helps this reach more people who care about Bitcoin and macro trends. Appreciate the support.
I think Bitcoiners, they take a Bitcoin view into the treasury companies, and without realizing that your sound money thesis and anti-fiat and Jeff Booth, don't feed the system and perpetuate it and all that, that is ideology, and that's correct. And as a Bitcoin maxi, that's the view I have. But that's not the world that we live in today. Mm-hmm. So, what percentage of people would you say have taken a 5% allocation to Bitcoin?
What percentage of people?
Yeah, 1%?
Tiny, yeah.
Less than 1%?
Less than 1%,
right.
Maybe.
And so that would be hardcore. Like they'd take a 5%. But even those people would have a 95% allocation to other things besides Bitcoin. So when you start asking, like, why would I buy a treasury company and not Bitcoin? As a Bitcoiner, that's what we ask, because Bitcoin is our hurdle rate. But 99.9% of the world doesn't ask that question. Mm-hmm. They're trying to beat CPI inflation, or they're trying to beat the S&P 500.
Yeah.
So they buy a basket of stuff, right? So right off the bat, a Bitcoin treasury stock is not competing against Bitcoin. And Saylor told me in Prague, we had dinner, he's like, I've never targeted Bitcoiners. He's like, I've never brought a Bitcoiner in. It's not a replacement for Bitcoiners. It's not a replacement for Bitcoin and cold storage. So the question that is most commonly asked in the Bitcoin space is, why should I buy a treasury company, not Bitcoin? And the answer is you shouldn't. Mm-hmm. The answer is you shouldn't. But they're not competing for Bitcoiners. Even the hardcore 1%ers still have 95% allocated to other stuff.
Yeah.
So most people are not asking, will it be Bitcoin, number one. Number two, I think this is just an a priori truth. If you buy a Bitcoin and I buy a Bitcoin and Bitcoin 10Xs, who makes more money? Same. If I borrow 30% LTV against my Bitcoin and buy more Bitcoin and you don't, and it goes up 10X, who makes more money?
You.
Why?
Because you've leveraged it.
Leverage, right? So that's just basic math, right? So why would a Bitcoin treasury company trade for more than 1 times? Because they're applying operational excellence, management, and leverage, right? So when you have like a fund, a closed fund, right? And there's, by the way, why would there be more than one treasury company? There's 1,000 closed funds in the US alone.
Yep.
Why is there 1,000? Why isn't there just one fund, right? There's 1,000. Each one has a different risk return profile, right? So with a closed-end fund, a lot of times we'll trade a one-time, sometimes a discount, sometimes a positive, right? A multiple, positive multiple. Why? Because there's a market and people trade it. But when you look at what like a treasury company is more analog to, would be a bank, right? So a bank takes customer deposits, they pay a yield on the deposits, and they invest the money and they make the arbitrage. It's also very comparable to a like gold mining company, a silver mining company. So I'm asset heavy, right? So I have the gold in the ground, but I don't trade at 1 times my gold value, my book value, because I'm an operating company. And so I'm going to get a multiple on top of my asset. So the banks are going to trade at 2 to 3 times book value, price to book. An operating company like an oil company or a gold company would trade 2 to 3 times that, because it's not just the gold in the ground, it's also the potential future value of the gold.
Yep.
Right? Oil is a little bit different because oil is so volatile, but like gold companies are priced a little bit different. So if you look at a Barrick Gold or a Newmont Gold, for example, you'll see them like a 2 or 3 times book value because the gold will be worth more in the future. Plus they have the operating leverage. They can use credit, equity, they can expand, they can do all types of things. So when you look at a treasury company, you go, well, they're more like that. They have an asset like gold. I believe Bitcoin's better than gold. So do you. I believe it's more explosive. So just right off the bat, they should have an increased premium than a gold company because their asset is better than oil or gold, in my opinion. Then we have the operating efficiency. Now, some treasury companies have terrible management and they should be discounted.
Yep.
Some are really good and they should get a benefit. So then the operating company itself, the management, et cetera, is going to get a premium or a discount based off of that. Okay, so that's why it would trade more than 1 times. This type of a company should never trade 1 times. It's not a fund like a ETF, right? They apply no leverage, right? It's just there's arbitrage against it, which is why the price fluctuates. But really, it's negative. Really, it should trade at a discount to NAV because they're charging fees every month. Well, what I think is that if we want to talk, and I talked about this with you before, like the game of money. And if we think about how to build wealth and what wealth tools do we have available to us, we understand that Bitcoin is the cheat code for us to do that. And Bitcoin allows us to use all these tools that the 1% typically had. So Bitcoin allows us, but we have to build a system for building wealth around Bitcoin. And so Bitcoin treasuries can be one piece of that system that we can build.
Mark Moss explains that while Bitcoin itself is a powerful cheat code for building wealth, owning Bitcoin alone is not enough. You still need a system around it. Bitcoin gives everyday people access to tools once reserved for the wealthy, such as leverage, collateralized borrowing, and long-term compounding. But those tools must be structured properly. The real goal is not to sell Bitcoin, but to build a wealth engine around it that allows you, your children, and even your great-grandchildren to grow and use wealth without ever having to sell the underlying Bitcoin.
I never want you to sell Bitcoin. I don't want your great grandkids to sell your Bitcoin.
Yeah.
But so we want to build a wealth engine around Bitcoin that allows you to grow your wealth faster, utilize all that capital, and even feed your great grandkids without ever selling the Bitcoin. So we have to build an engine around that.
Yeah.
And so let's just take traditional finance. So you have maybe the champion of that would be like a Dave Ramsey. And Dave Ramsey would say, save % of your paycheck and put it into mutual funds and never use debt.
He's the bald guy that I see like people call him up and say, I'm in a lot of, okay.
Right. And so, he makes hundreds of millions a year. He's not just some old, country folk guy. Like he's really smart. But his advice to everyone is don't use debt. Work hard, save, put it into mutual funds, let it sit there for 40 years and compound. And then what happens is traditional finance says at some point in 40 years from now, you can sell 4% of your assets per year. And if you time it just right, hopefully you'll die before you run out of money and you'll die with zero.
Yeah.
There's a whole book, a whole movement around die with zero, which as a Bitcoiner seems like the worst idea. That's a fiat idea.
Yeah.
If we think about our life as like a blockchain, like my life, I should have a proof of work that I was here. What is the stamp I'm leaving on the world? What is the proof of my life? And then my kids should start on the next block.
Totally.
And then they should add to that block. And why should my kids start from zero? So I think the Dave Ramsey traditional financial advice is a fiat mindset. Save for 40 years, spend it down to zero. Hopefully I die before I have zero and my kids start from zero. Whereas we're Bitcoiners, we want to push value into the future. So right off the bat, that system is broken. But again, yes, I never want you to sell your Bitcoin. I want you to set up a system where your great grandkids don't sell your Bitcoin and they don't need to. But what it really comes down to, and we can come back to this, but passing down the Bitcoin is the asset, but that's not the inheritance. What we want to pass down is a system that allows my great grandkids to continue to grow the wealth and use the wealth without selling the Bitcoin. So if we reframe it, we want to understand a couple things. And I'm going to use Michael Saylor as an example for this, but we want to understand that what traditional people do is they work for money. And what most people try and do is make more money. So they're going to go back to school. They're going to get new skills. They're going to work harder, longer. They're going to get a side hustle, start a new whatever, right? They're going to try to make more money. Then they're going to pay taxes. They're going to live on whatever's left, and then hopefully they have a little bit left to save, and they'll follow Dave Ramsey's advice. But what the wealthy do is they use income to buy assets. And then those assets compound, and the assets pay for their life, and they never run out. Okay? Now, let me give you an example. We'll talk about Michael Saylor. So he talked about how he spent he did 10 trips around the world and he couldn't get MicroStrategy to grow. Remember, he's like, I tried everything. I hired this person, I tried that. I merged with this company, I bought this company. I was competing against Microsoft. I couldn't win. I couldn't increase revenue. So just like you and I, but at some point we can only work so hard. Yep. He couldn't increase the revenue of MicroStrategy. He tried everything. So he had assets. He had 500 million of assets, but it was melting. And he's like, what do? I could try to buy another company. I could try to hire more people, but I've proven now for 10 years, I can't grow the revenue, right? So like most of us as a mom and pop, a homeowner, we have a little bit of assets. We have equity in our home. We have some Bitcoin, but we can't work harder. I've got a side hustle. Like I can't increase revenue that much. Okay. So that's Michael Saylor. So what he decided to do was change the business from MicroStrategy to strategy, drop the micro. And instead of trying to grow revenue and sell more software, I'm going to just build the asset base that I have. I'm going to run my treasury, right? Within 5 years, he took MicroStrategy from 3 billion to 50 billion. So he spent a decade and couldn't grow it. And within 5 years of the new strategy, he went from 3 to 50. So you and I, what can we learn from that? Well, we understand that the rich don't work for revenue. The rich work for assets and the assets built. So what we want to do is instead of trying to make more money, how can we leverage the assets that we have today to build wealth faster? I think the 4-year cycle is over, in my opinion, because I think it was never about the 4-year supply demand shock. It was always about the global liquidity cycles.
Yeah.
And now there's, I've been hearing about this from Michael Howe, been hearing about this from Raoul Paul. He does really great work. I know Bitcoiners don't like Raoul Paul, but Real Vision does a lot of really good work.
He's got terrible, like, quote unquote, crypto takes, but good macro takes.
Really good macro takes. And I know a lot of people want to throw the baby out of the bathwater, but I can not agree with his SUI or whatever, his NFTs, but I could also appreciate he's got good macro takes. And Real Vision has some really good global liquidity charts. They were the first one that really opened my eyes to the ISM business cycle, which you see a lot of Bitcoiners running with right now. Yeah. And so I think the macro is always in the driver's seat. So from that perspective, I expect it to be a good year. What I'm watching for, what the gray swan is, what I'm cautious of is that it's a political reason. And that is that Trump is really kicking the hornet's nest, let's just say.
Totally.
He's certainly trying to disrupt the deep state, from taking down the NGOs with USAID to blocking, fraud in Minnesota to maybe Venezuela being part of taking out some CIA deep state stuff. Like, there's a lot of hornet's nests that are being kicked up, and the deep state, the powers that be, have never wanted Trump in office. So when he took office the first term, they came up with the Steele dossier, the Russia collusion hoax, all of that. They tried to impeach him, multiple times. They piled in, 100 lawsuits against him. They shot him. And so whoever those people are that are doing that, don't want him there. And one really good way to make sure that they get out in 2026 being a midterm year is to not let the markets rip.
And he needs those markets firing going into
He needs the markets firing, or that the Republicans could lose the midterms this year in 2026. And so it could happen, and this is what I'm paying attention to, potentially using the markets, the Fed, the interest rates, the banks to bring the markets down into the midterms so that they could change the power.
Mark Moss ends with a controversial but serious concern: political interference in markets. He argues that Donald Trump's efforts to disrupt entrenched power structures, from NGOs to regulatory bodies, are provoking backlash from entrenched interests. Markets matter politically. Strong markets help incumbents win elections. Weak markets flip power.